Welcome, Michael Bell, founder and managing director of Primar Capital. Thanks for being with us.
Great to be here, Bentley. Looking forward to it.
Yeah, so here's what I'd like to do. As just kind of frame the conversation today, I'm going to assume that most of our clients and prospective clients understand what private equity is. They understand the value of owning private equity, the potential returns, the diversification benefits, and so forth. In fact, almost all of our clients do own private equity in some form or another. With that, as you know, there are some hurdles, there's some difficulties in owning private equity, everything from subscription documents, capital calls, extended lockup periods. And so I wanted you to talk a little bit about what you all have done at Primark and how you've overcome some of those hurdles to get more people exposed to private equity.
I'd love to do that. Thanks, Bentley. So, the private equity asset class has traditionally been just very difficult to access. Right. And it's because of all the things you just mentioned, really high investment minimums, investor eligibility requirements, liquidity lockups, 5, 7, maybe 10 years, and more complicated tax treatment through K-1s and the like. But some of the most difficult issues with private equity has actually been getting access. Private equity is very much a club-like environment, and you have to be a member of the club to participate in it. And right now, the members of that club, or previously the members of that club, have been big institutions, big endowments, pension plans, family offices, sovereign wealth funds. Okay, they are in the club. They can write really big checks. All right. And so what we've done at Primark, we've provide simplified access to private equity. Okay, we've put private equity, pure play, middle market private equity into an easy to access investment vehicle. It's called an interval fund. That you can access it with a ticker symbol, okay, that looks and feels a lot like a mutual fund, except the liquidity features on it. You can invest every single day like a mutual fund, but you can exit that on a quarterly basis. So that's in essence what we've done. So we've taken an institutional asset, we've put it in a structure to make it easy to access for a financial advisor, and we've removed all of the burdensome subscription documents. We've removed the high investment minimums. Okay, we brought that down to $5,000. We've removed the complicated tax treatment of a K-1. This is in a traditional 1099. There are no capital calls in this type of structure. There are no performance fees. You've heard of the 2 and 20. There's no performance fees in this type of structure. And it's available, it's easily available to most financial advisors.
One of the places we have been using this strategy is we use it really across the board, but where it's really helpful is when we have a family member that's not a qualified purchaser, accredited investor, that still needs exposure to that asset class, that still needs those diversity benefits. And it's allowed us to bring that to every client in our portfolio. So that's been a huge benefit for us.
Well, that's the structure that we've developed here, Bentley. A lot of these other structures, when we've talked about, accessing private equity, it's this, club for institutions. Some investment structures have brought it down one level to say, okay, it's only for accredited investors or only for qualified purchasers. So there's, a portion of your client base that doesn't get access to it, even though you believe in the asset class, you love the return series of the asset class, you love the diversification of the asset class. it's just not available to everybody. We wanted to provide access to this asset class for all investors.
You might comment on the benefits of avoiding the J curve.
So in private equity, there is something that is called a J curve. And what that means is in a traditional private equity structure, there is a capital call for part of your investment. Let's say you put up $5 million, and there's a capital call for $2 million. And what the general partner is going to do with that $2 million, they're going to go find an investment and a second investment, maybe a third investment. And after they fill those up, they're going to go call some more capital. But during those first, 18 months to 24 months, they're making the investment and they're drawing down capital. And eventually they will look to sell some of those investments and you'll get a return from the investments they've made after several years, 2-3 years. So the J curve is the downward sweep of making the investments. Then those investments eventually start to pay off over the life cycle of that fund, which may be 5, 7, 10 years. So you get this traditional curve that's called a J curve that Bentley mentioned. How we avoid that J curve is we are investing in seasoned portfolios of companies now. Some of those are what are called secondary investments, where a portfolio manager has made that investment 3 years ago. So we're buying it 3 years in. So it's starting to be at a point where, typical private equity investments are sold over a 3 to 5 to 7 year business cycle. If you buy it 3 years in, you kind of avoid that downward trend J curve because you've already bought it on the upswing. So our portfolios have some assets that are already through the J curve.
This is a perfect transition into explain a little bit about the thesis behind your allocation, what those allocations look like, and kind of what you expect over the next year or so as you're fully developing that portfolio.
Sure. So our allocations are really in the 3 buckets, if you will. There is an allocation, but we have to provide liquidity, every quarter for investors that want to exit. So about 5 to 10% of our asset class will be in liquid securities. And that will be cash or private equity-like liquid securities, something that we can sell out of to provide liquidity to allow investors to exit the portfolio on a quarterly basis. That's 5 to 10% of the portfolio. 15% of the portfolio will be private equity funds. Your traditional, what they call GP, LP structure that are really only for accredited investors, qualified purchasers. We're allowed to sprinkle in up to 15% of those types of investments into our product. The last big allocation, which will be almost 80% of the fund, will be direct co-investments. And those direct co-investments are achieved through our portfolio managers network of relationships. And those are direct investments in private companies. And some of those direct investments in private companies, some of your clients may perceive those to be public already. For example, Chewy's or PetSmart, for example, that we've invested in, or Visma or Genweld or Culligan Water, for example, Cole Haan Shoes. All of those companies we're invested in, but they're private companies that you can't access. So 80% of our portfolio will be privately held companies that we get access to through our relationship network.
Yeah. So are these typically auctioned opportunities, or is it strictly because of the network you've built that allows you to kind of have access?
This is the club network, fortunately or unfortunately, and that's how these opportunities trade in the market. This is not a secondary market where you can go buy and sell and trade this. There are secondary markets that have developed around some of these securities, but there's a fairly decent a premium or discount on those opportunities to buy them. We get access to them mostly in off-market transactions that are made available to us just through the relationships that we have.
Well, let's wrap up there. We'll keep it succinct and digestible quantities for our friends watching. And I hope you will come back, maybe give us an update at a future date.
We'd love to, Bentley. Part of entering into this asset class is education and better understanding what the asset class can do and benefit to an end client. We'd love to provide any additional knowledge and education that we can in the future. Thanks for having us.
Keep up the good work. We'll see you soon.
Thank you.